we talked about this last week, Adam, yourself and I, but I mean, really, that's what's going to happen, right? If you start taxing the citizens at a higher bracket, or at least the wealthy more, they're going to move their money elsewhere where they're going to get tax loans, right?
Yeah.
That money's just going to leave.
You're listening to the Ottawa Real Estate Podcast with your hosts, Paul Stevenson, David Warren, and Greg Campbell. Let's see what's going on in the world of real estate today.
Hello, and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things related to the dynamic real estate market in Ottawa and beyond. I'm your host, Paul Stevenson, a mortgage agent level 2, and I'm joined by my co-host, David Warren, also mortgage agent level 2 and owner at Referral Mortgages, and Greg Campbell, seasoned realtor with deep insights into the local market. Greg will be joining us shortly. Today, we have a special treat for our listeners as we're joined by a distinguished guest, Adam Schacter from Embark Wealth and Design Securities Limited. Adam brings a wealth of knowledge and expertise in wealth management and financial planning as a financial planner, providing us with valuable insights into how real estate fits into a holistic financial strategy. Adam, we'll bring Adam in right away. Adam, I have to tell you, we usually let ChatGPT write our intros, so we never know what's going to come of it. You know, it's always a mixed bag. So you are now going to give us a holistic financial strategy around real estate, just so you know.
Just
how you doing?
forewarning.
Welcome to the show.
Forewarning on what we're expecting.
Yeah, forewarning.
Bring it on.
How's it going? Welcome to the show.
Thanks so much for having me, guys. I appreciate it.
And David, how are you doing? We usually don't bring the guests in right away, so I kind of like it.
No, I know.
Throw them right into the fire.
Yeah, pretty good. It's been a good weekend, good past week. You know, a lot of conversation around, you know, with people, whether it be clients or whether it be just friends and family, about the budget and the market as a whole. And kind of, yeah, I found certainly the conversations have really flowed from this last budget of all different kind of topics that it covered for the general population. So I don't know if you're the same, if you're getting calls on it from people this past week as well.
Yeah, right after the budget was released, I had 2 clients reach out to me being like, can we take advantage of this 30 years now? They're first-time buyers on new builds, but they're looking at like a 2026 build. So I told them, yes, but I can't, you know, we're kind of caught in the middle now where it's like, we can't really pre-approve you yet for a 30-year amortization because, you know, it hasn't actually hasn't been activated yet. You know, that'll take effect in August, but there are still, like, the conversations have started already. So I think that is that shows the direct impact that these sorts of decisions have, that people hear it and they start talking right away. And we're at the other end of those conversations. So I think between that and, you know, we talked about it last week, the RSP contribution room, which Adam, obviously, you know, that's something that you would be dealing with as well, but being able to withdraw under the home buyers plan for $60,000 now, you know, that almost doubled the amount that you can withdraw to your RSPs, I think is a huge benefit for first-time buyers. So I think the combination of that 30 years and the increase to the RSPs is going to be very interesting to see how that kind of shakes out into the market, especially with the, you know, they're talking about mass producing homes and, you know, these kind of catalog of new homes that's going to be coming to Canada. So it'll be really interesting to see how this all kind of plays out over the next 3 to 5 years, I would say. On your side, Adam, like, you know, I'll just pass the mic off to you. Like, at a high level, like, what on your side as a planner, what were kind of some of the main takeaways that you saw from the federal budget that are going to have an impact on Canadians and the economy as a whole?
Well, I was thinking when you mentioned the increase, the RSP's first-time homebuyer withdrawal, it's really just continuing to hammer home how Canadians that are buying their first homes can save for a down payment. And we saw even just last year around this time, the introduction of the first home savings account. So what we were recommending last year, even for those that weren't intending to buy a home, but that qualified as a first-time home buyer, was to open up a first home savings account, get $1 in there for tax year 2023. Some of them were doing this right before the end of the year in December, so that you can get carryover room for 2024 and beyond, and continue to just put money into your first home savings account, which is $8,000 a year for 5 years, total $40,000, and use those as deductions on your income so that you can save on taxes. And if you don't even end up buying a home, you can take that $40,000 plus whatever growth you got and roll it into your RSP without using any of the RSP room. So there's just, every time something new comes out, you know, there's a bit of a scramble from a financial planner's perspective to kind of assess what the impact is. And the most recent budget proposal that came out, I think most of the chatter that I received was on the introduction of the increase to the inclusion on the capital gains tax.
Yeah, I think that's kind kind of the really big one that I was speaking with clients about that have investment properties. They're, debating whether to liquidate this year or not, whether to put it up on the market because their term is coming up, and just where the market as a whole, whether they're interested in holding that. And I, subset where they, decided to hold it. And then others were, instead of delaying till later on in the summer to list, they're listing, right away in hopes of being able to get a sale and line it up before that deadline. For those listening, I mean, the June 25th deadline, is there clarity around whether that it's just when the purchase or sale agreement is signed, or does it have to have closed by then? Any idea on that, on those stipulations?
I have no idea. My understanding is when I place an investment trade, for example, it's when it's initiated. So it would likely be the closing date as opposed to when somebody moves in. So I think that a closing date would probably need, but I don't have confidence in that.
Got it. Maybe you can kind of, and I know you had, we were talking about just before coming on, you had a great kind of breakdown in your newsletter last week about it, about the differences in that, and kind of going through that increase of the capital gains and inclusion rate. Maybe we kind of touch on for people what that implication and change is and how it breaks down for both the individual and then those that hold maybe an investment property in a company.
Yeah, I mean, two big differences holding it individually and in a company. A individual has a $250,000 leeway threshold on the increase of inclusion. What this means is if you buy something for $15 and sell it for $20, just to use a simple example, that would equate to a $5 capital gain. Now, your first $250,000 of capital gains in any given year is exempt from any of the increases that are being proposed in this budget. So the way that a capital gain works is, under current rules, is only half of the gain goes on your tax return. So 50% is the inclusion. So if you bought an asset for $15 and sold it for $20, you would have a $5 capital gain, and half of that, $2.50, would be included on your tax return. That still is going to be in place for the first $250,000 for those incurring capital gains personally. Anything after $250,000 in a year is going to be 66% included instead of 50%. And so where this is impactful on real estate, with an investment portfolio, a planner can decide, okay, well, we're going to incur $249,000 worth of gains personally to stay below that threshold. And then next year, we'll kind of pare this back and do some more. But with a property, you can't sell one house per year every 5 years to dispose of it. It's an illiquid investment, an illiquid asset that has to be disposed of in its entirety. So if you've purchased this asset and it's appreciated, significantly past the point where the gain itself is over $250,000, that's where you're going to feel the impact.
And so that's on the individual side. But I believe it's, on the corporate side. And then this isn't just investment properties either. This is for people that have cottages or anything like that. So when they kind of came out with it, when they came out with it, talking about this is only going to impact, I think it was like 0.13%. They tried saying, but really it's impacting anyone that has a cottage that maybe inherited that cottage or that's held it for many years, because it's typically held, a second home held for an extended period of time. It's impacting those individuals that, might be some they're handing down or that they hold and it's part of their retirement plan.
Yeah, I think there's some smart people that do these things, but there are always going to be unintended consequences for who they're trying to go after and who ends up maybe kind of feeling the brunt of this a little bit more than what was supposed to. There's a few examples I can give if you're interested. Those that own property in corporations, there's no $250,000 threshold for the inclusion rate. So the increase is going to be from 50% to 66% included on any dollar, any capital gain, irrespective of how much. But there's even a nuanced other sort of fallout from this is when you sell an asset in a corporation for a gain, half of that previously was taxable, and the other half actually goes into what's called a capital dividend account. And whoever owns that company can withdraw that money from the capital dividend account tax-free. So in the example I gave, if you have $20, if you bought an asset in the corp for 15 and it's worth 20, and you sell it, you have a $5 gain. Under previous rules, half of that, $2.50, was taxable, but the other $2.50 went into a capital dividend account that you could withdraw as an individual from a corporation tax-free. With the increase in inclusion rates, you're going to have 66% included, so only 34% will go into a capital dividend. So you're kind of getting dinged on both ends, in my view. So that's not ideal.
Yeah, I think kind of what you kind of alluded to is that I think the change was meant to go after a certain subset of individuals that they kind of considered as the ultra wealthy, when in fact it's, hitting everyone from, of all different income classes that maybe either like I said, inherited something, that they're getting taxed on, to those that have a professional investment portfolio, whether it be equities or real estate.
I know people that just bought a rental property, smaller town, et cetera, and this is part of their retirement plan. And they have a couple properties that are taxable to them. And when they sell them, they're just going to have to pay more taxes than they thought they would otherwise. And this rule change wasn't intended for people like them.
No,
No, and I mean,
it's kind of ironic that the budget is focused on housing. Was a main goal, is increasing the housing supply for rentals and for resale, but bringing in, increased taxes on real estate kind of is going against what you're trying to accomplish, right?
I think they're really pushing it for the first-time home buyer, right? Because they're allowing everybody to buy that first home, and the home that you own and live in is a tax-free asset in Canada. So they're basically saying buy one home, and they're making it a little bit more difficult to have assets outside of that as part of your plan, whether that's real estate or otherwise. But certainly real estate would have a bigger impact because it's an illiquid asset to dispose of. You have to dispose of the whole thing.
Dave, do you remember the percentage of homes in Canada? I know we talked about this maybe a year ago, but I'll just throw it at you. Do you remember the percentage of homes in Canada that were rentals, like that weren't owner occupied?
Well, there was a period through COVID that 1 in 5 that were being purchased was individuals for rental purposes. But the interesting thing with that though, and to your point, Adam, like that their intention is just buy one property and that's it, and don't buy any others, is that government's not creating rental units or getting into that. It's based, it is on the private sector, and for houses, like not condos, even for these affordable housing developments or anything like that, it's really kind of in that 1 and 2 bedroom condos or apartments, not in houses. Like, we've talked about it before. There's, you've got families of 3, 4, 5, 6. They're needing actual single detached homes or townhomes. Those are not being provided by, the CLVs of the world, the larger corporations that focus on rentals, or through affordable housing. It's always kind of just an apartment unit. So this subset of rentals is the mom and pop investor that are supplying that type of housing to the general population for those houses, for those families. So kind of going after them is going to remove or slow down and make people second guess what they're going to acquire as far as a type of property or whether they buy it all. And I think it's going to hinder that market. Now, whether that's will be the mindset right now or whether that'll be the long-term mindset, who knows? But certainly I think that's where right now a lot of people kind of second guess whether they're going to buy that rental or hold on to that single family.
Sorry, Paul, go ahead.
Well, I was going to say, from your perspective, like as someone who speaks to clients day in and day out about like financial decisions and where they should be putting their money and so on, have you noticed yourself, like you've been doing this for a decade now, have you noticed yourself over the last 5 years, really since the onset of COVID, have you noticed that people have been shifting their focus towards, or at least having the conversation and entertaining the idea of an investment property? Like, is that something that seems more common now than it was, say, 10 years ago? Or is that, have you not seen that needle move much?
I think it's always in the back of people's minds because people follow the real estate market more than any other asset. Everybody knows how much their home is worth and what the house on the street sold for. And everybody seems to have sort of for whatever reason, an ingrained sort of notion on that is how wealth is created, because it's just something they know or something their parents or grandparents did, or somebody they know's grandparents and grandparents did, and how they achieved financial freedom and creation of wealth. My view on these things is always, the law of gravity doesn't even work the same way if you're far enough away from the earth. Everything's sort of situation dependent. So interest rates change, rents and the amount you can charge rent changes, like market value for how much you can charge. the value of the home changes. And so you're just really kind of looking at all the variables and what it is present time. But I haven't seen a huge change to answer your question, Paul. It's just always something that seems to be brought up as a way to create and maintain wealth and have passive income by owning a stable asset, or what seemed to be a stable asset.
Now, you commented just now on interest rates. What are you seeing in the market right now? And this is kind of a crystal ball question. Now that we're 4 months in to the year, what are you seeing? We've got a pause in May from the Bank of Canada from a policy rate decision. Some of the inflationary numbers came out last week, and the U.S. Fed spoke as well. What are you kind of thinking? What around the water cooler talk at your shop, and what are you seeing or predicting for kind of the year going forward as far as where the bond markets and the Bank of Canada policy might be?
So first and foremost, what I think does not spill into our framework at all, because I can't make those calls on people's retirements and their kids' educations and their legacies, et cetera. So we try to keep any sort of insight out of our framework, which is as robotic as possible. But with that said, I do have comment if that's of value. So where we're sort of seeing a lot of money flow, which is a good indicator of what people think, there's a lot of money flowing outside of Canada. I mean, leaving Canada right now. And the only real inflows that are being seen in Canada is in the bond market, which suggests that people think interest rates are going to go down in Canada earlier and more aggressively than in other countries. I'm talking about global money. But what's interesting is that the purchases or inflows of Canadian bonds, and not sovereign like Bank of Canada bonds, but Canadian corporate bonds, the inflow seems to be being purchased with US dollars, which suggests that the Canadian dollar is likely also going to go down. So if you're buying a bond in Canada with US dollars, what you're saying is, I think that interest rates are going to go down sooner and more aggressively in Canada, but I also think their currency is going to wipe that investment away a little bit. So I'm going to use US dollars to do it.
So getting the increase on the currency spread, and then as well the yield curve.
Yeah,
rates go down.
Not necessarily getting the increase on the spread, but avoiding the decrease.
Yeah, yeah. I think I've kind of this. It's funny you say about the outflow of funds from Canada, because I specifically heard that from somebody this weekend of that in their entire circle. Basically, it's exactly that. The focus has been of buying buying US equities and outflow, which I thought was interesting as well. So it's kind of coincidental that you.
Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction. At Geltin Poirier Avocat Lawyers, we love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you. For an effortless client experience that opens doors, call us at 613-744-4488 or visit our website at geltinpoirierlaw.ca. Let's get to the heart of your deal.
We talked about this last week, Adam, yourself and I, but I mean, really, that's what's going to happen, right? If you start taxing the citizens at a higher bracket, or at least the wealthy more, they're going to move their money elsewhere where they're going to get taxed less, right?
Yeah.
That money's just going to leave.
I don't know, but I can only speak for myself. Like if I have the means to, pay less in taxes or move or whatever, I was saying to my mom, she was saying, well, if you leave, isn't healthcare going to be more expensive where you go to? I was like, well, for somebody that makes, I'd say like middle to high net worth, like making $500,000, $600,000 a year, if you're saving $200,000-$300,000 in taxes, wouldn't you be able to use that to just pay for medical per year?
Mm-hmm. Private doctor.
So I can speak for myself. Like I love this country, I love being here, etc. But it is tempting to spend 6 months plus 1 day somewhere else. One thing actually I'm thinking of is if you leave the country, all of your assets are taxed as if you sold them right now. So it doesn't mean that you actually sold them, but they're taxed as if you did. And that's where capital gains, when we were talking about earlier, would kind of rear its ugly head. So if you're planning on leaving Canada as a wealthy-ish individual or family, you probably should do it before June 25th if you're going to do it anyway. So you might see a little bit of a bump there, as well as, like David said, like a little bit of bump. And maybe if you're planning on selling a property and it's going to be in excess of $250,000 of capital gains, there's no reason why you wouldn't want to list it sooner rather than later.
I think we mentioned this as well when we were chatting, is if someone is to pass away, like that estate, right? Like if you're getting an estate from a deceased relative, that's also going to be subject to that capital gains instantly, right? Like you're going to be subject to that.
You know, a lot of countries have an estate tax. We don't. We just pay income taxes. But the way it works here is when you pass away, all of your assets are deemed to have been sold, even if they haven't. Same thing if you leave the country and become a resident elsewhere. And that completely takes away the ability to plan to incur taxes over a longer period of time, which a net overall might be a little bit less. So similar with selling a piece of real estate and not being able to sell one home per year over 5 years, when someone passes away, potentially unexpectedly with a bit of wealth outside of tax deferred or tax sheltered account, you're going to incur all of this in one go. So if you have maybe 3 properties and each of them has a $200,000 embedded capital gain within it, taxable, then if you didn't pass away, you could really sell those 3 properties in 3 different tax years. But once you pass away, that would be a cumulative $600,000 capital gain that you have no further control over as far as spreading it out. So it should reduce a lot of estates accordingly.
Yeah, it's very interesting. And I'm happy that you clarified that, and this is great that you're on, because I think these are things that we probably would have overlooked, or at least not thought to think of even, right? So that's a really good angle to have your perspective of it. Welcome, Greg.
Hey,
hello.
Guys.
Hey. How's it going?
Yeah. Thanks for having me.
Welcome, Greg, to the show, everyone. Greg is a realtor and
with host Adam. Yeah, that was cool. Just jumping in on that. I don't know if I may. I heard something the other day. I was listening to Steve Saretsky out of Vancouver, and I can't remember where it was coming from, or maybe it was Tom Story. Anyways, I listened to a lot of podcasts after the budget was released, and people are pretty, and I've talked to some investors who are immediately not interested in Canada at all anymore. Like they've been kind of working on it. They've already been working on it out. I talked to a couple sellers who are leaving the country because of certain things, taxes being a big one, moving to a state that has only 15% tax. That's it. And anyways, there was one comment that was made about rates and about buying, where they were saying that it's very interesting how people want property values to come down so that they can afford to buy a home. And then they were saying, but the flip side to that is, so what happens when the prices come down and then people want to buy the one thing that's supposed to be like a lifelong asset, something where you're always going to appreciate. So let's say all of a sudden prices drop 30%. Now, are those buyers, are they really going to want to buy that asset that dropped 30%, or are they going to hesitate even further because they don't want to lose money on an asset that may drop even more?
Greg, do you mean like the confidence in the real estate market itself would be down, and therefore the buyer would be...
Therefore the buyers are saying, we want rates to drop because we want home ownership. But then if they want rates to drop. But if the rates drop, chances are prices are going to go up, right? So then further, they may not want to buy. And then they're saying, well, if the value of a property comes down and the rates come down, then what if it keeps decreasing? So then there's less and less interest for buyers even to get into the market, because even though maybe they can afford it now, they're seeing the value decrease. So, and the way that Canada's working, they're saying there's no way that they're going to be able to build these homes. They're saying, that's what it was. Steve Saretsky was breaking it down from how many homes they're intending to build by 2031 down into all the way down to like the day or per the hour, how many homes by the hour.
I saw that too.
And he's like, it's just absolutely ridiculous. It's impossible to even do half of what they're predicting. So if they can't do this, then, buyers are just going to be even more like, there's going to be no reason. They're not going to want to purchase a home ever.
We saw that this past year, though, in January, February last year in 2023, when we were talking about, kind of watching the trend of prices, people sat on the sidelines, even though during that period, we hit that bottom of where value was. And then for the average house price, and then we saw it bounce back up. But even when it was at the trough, people were still, because of that psychologically, they were trying to time the market to buy at the lowest peak.
Right.
lowest point. Same as on the equity side, people try to time it. And so people psychologically just stay out as opposed to, just buying when it is the right time for them, or, in the case of an equity, it's just buying the whole time. But we saw that on a small scale of people staying out of the market last year when values were going down for exactly that point.
Sure.
Yes, interest rates were up, but they're like, well, values are going down. I want to hit the lowest. I want to get it on the lowest point. Yeah, I mean, it's kind of just human nature.
Yeah, I see it on
it's at
a
a
large
point
scale
now.
all the time. Just like the real estate market's relatively stable compared to like the stock market. We don't have like I don't know anybody that's timed things properly in the stock market. You could see cycles even in like intraday in the stock market.
Nancy Pelosi does pretty well.
What's that?
Nancy Pelosi does pretty well.
Oh, I'm sure she does.
Times the market really well.
But to David's point and to Greg's point, like people don't want to buy a declining asset emotionally.
Exactly.
Yeah, and it's a very good point, and I think it's something that I think the policymakers probably do take into consideration, but I think the general public, when they're talking about these things, that's oftentimes not considered as the actual psychological side of humans and how they're going to react to these sorts of things. As you said, Greg, like, yeah, great, rates are low. Now's a really good time to buy. Yeah, but prices are down 25%. They're probably going to keep going down. Maybe we should wait a little further. Or maybe this isn't actually even a good asset. Maybe we should look at stocks now. Maybe this isn't where we want to be. Maybe we should just rent indefinitely. Like it does shift as the needle moves, people's psychology changes as well. Some of the other things, so 3.9 million homes is what they said to be built by 2031. So some of the other things, just to kind of high level budget talk. So on the educational front, 48 million has been allocated over 4 years to forgive loans for early childhood educators. 253.8 million dedicated to loan forgiveness for various health and educational professionals. Let's see, environmentally, 900 million for green homes and energy efficiency programs, and detailed plans for a national flood insurance program. Healthcare, we got, let's see, announcement covers groundbreaking pharmacare initiatives, including the provision for contraceptives and diabetes supplies with a total allocation of 1.5 billion over 5 years. Mental health services receive a significant boost through various funding initiatives aimed at expanding access, particularly for young and Indigenous populations. Indigenous communities stand to benefit from over 5 billion in loan guarantees for resource projects alongside investments in education, housing, and infrastructure. Foreign policy and defense are also notable, with an ambitious target to boost military spending to 1.76% of GDP by 2030. AI and technology receive a forward-looking investment of 2.4 billion, aiming to position Canada at the forefront of artificial intelligence research and development. That's something that we kind of talked about briefly with regards to the kind of 3D printed homes and continuing to develop things in that regard. So that's kind of at a high level. There's obviously, I mean, the budget was quite long, and we could probably do a 3-hour podcast on the overall budget. But how do you guys think, like, just to kind of to wrap up the conversation, I guess, on this side of things, like, how do you guys see this impacting, let's say, even the next 1 to 5 years in Canada? Anyone can go first. No,
I think right now, like Adam said, there'll be like a blip of people unloading equities or unloading rentals between now and the end of June. I think kind of people's, the mom and pop investors, it'll be on their mind right now, but they'll kind of forget about that. Or if buying a rental property wasn't even on their mind now, and they're not planning to, in a couple of years' time, it's just going to be, that's what the taxes are. And they don't even really think about it, because people don't, in my opinion, people aren't necessarily always buying their one rental property with the mindset of what's that tax implication going to be down the road on it when liquidating it. A lot of people aren't on an individual basis thinking of that long term. They're just in the here and now of, let's leverage my equity, or I've got savings. And like we talked about, real estate is, always talked about, and they want to own that. They know that it appreciates in Canada. I think it's going to be the larger institutional buyers and developers that are going to potentially shift their focus to markets that are more advantageous from a tax perspective, and kind of pulling out of the market locally.
Well, one thing I can add to this, and this not to diminish all that we've been talking about for the last little bit, is you can own an asset several different ways, and you can get distributions from that asset in several different ways, depending on how things are structured. And the best way historically to own an asset is in deferred capital gains, which is you buy an asset and you wait for it to appreciate, and you don't pay any tax along the way until you dispose of it or you're deemed to have disposed of it for reasons like changing residency or passing away. Currently, under the new rules, it is still the best way to own an asset from a tax perspective. So it's just less so. So I just wanted to throw that in there as well, as there is an implication to this. It just makes it less attractive than it was, but still the most attractive way to own an asset. And in my newsletter, I ran by a scenario where somebody incurred taxes sooner rather than later. So somebody sold something before the deadline so they could get within that less tax. But as a result, they paid taxes sooner rather than later and had less wealth sooner rather than later as a result. And that reduction in wealth was allowed to grow over time. And so whether to dispose of your assets sooner or later really depends on a function of how long you intend to hold on to it. Because right away, it's a decrease in wealth. And if you're going to sell that asset a couple of years down the road, you pay less in taxes, maybe you can make up for that. But if you're going to hold it for a long time, the higher wealth growing for longer is actually going to win out. So it really depends on when you're going to sell it. I have one client, this isn't real estate, but he has a lot of embedded capital gains held within a corporation. He's an older gentleman. He plans to cash out and incur the taxes over a span of 3 to 4 years, not 10 to 15 or 20. And I did a side-by-side comparison, and we felt that it was better to cash things out before June 25th, increase his capital dividend account, incur taxes at a lower rate sooner. So I think a case-by-case basis of running side-by-side numbers is the best way to go about it. But ultimately, it's not going to be an impact in I should do this versus that, because it's still the most tax efficient way to own an asset.
So what you're saying is speak to a professional.
I was just going to say, like, you hear, people hear this budget and the dad listened to, well, I heard it on CPAC or what have you, and they just hear kind of that high level or one person's opinion. Like, it's so important to actually talk to someone like Adam or anyone who's actually a professional in the taxation side of things, so you can understand what the actual implications are for you personally. Like, this might have absolutely no implications on you currently in your life. It might in 10, 15 years, and that's why it's important to plan. But today, you might hear something like, oh, the sky's falling, and it might literally have no impact on you. So it is important. It might have a huge impact on you. So just important to talk to people that actually know, not just
or even people that know your unique situation.
Well, exactly.
Yeah.
Right? Because everybody's going to have a different set of variables, right?
Yeah, like the halal mortgage thing. That was a hot topic on some posts that I saw. They were just like clickbaiting and then making Canadians think that people that, from the Muslim community getting mortgages weren't paying interest or something like that, that it was just free money given out and they had to pay their taxes. And it's like, well, no. Learn a little bit about it before, right?
Yeah. Well, it'll be interesting to see if that actually comes to fruition. I know they're researching it now but before we wrap up quickly, Greg, what have you seen that I know you jumped in halfway through, so I'll ask you this now, but what have you seen in the market this past week from a numbers perspective?
From a numbers perspective, it's moving. There's more listings coming out. And I've talked to people in some different markets right now, and there's more listings coming out. There's stuff selling, but the listings are by far, it seems to be increasing more than the sales. I've seen a lot of deals fall through, and I've heard of deals in other markets falling through for one reason or another. I don't know, I'm optimistic. I'm always optimistic on where things are going, but I'm just finding that there's more people that are hesitating on both sides than I've seen in a long time. People teaming up to buy properties. They're finally doing that. We've talked about before, right? Coming together to buy a home with other family members or other friends because they can't do it on their own. Lots of different ideas coming up. But I mean, the prices are still kind of the same. It's not dropping like crazy. It's only increased over the last little bit. It's going to be interesting to see what happens by the end of this month, because I think the average is going to be up again. We said we saw 585 last November. Now we're up around probably 640 as an average. That's substantial, especially with the rates where they are. And I mean, I think that all these people anticipating this rate drop, I don't think it's smart that if that happens at all.
It's still every week. Like last week I had multiple conversations with people telling me like, oh, when do you think rates are going to come down? Like, that's like just, it's front of everyone's mind. It's
Yeah.
all they're getting fed. It's all they're hearing. And it's the front, it's the first thing in all our conversations. And I literally said to this client, I'm like, well, rates are actually down almost 3/4 of a point from,
Right.
6 months to a year ago on the fixed side. Like, rates are actually great right now from like compared to where they were at 5.74. Yeah, like 4.99 is substantially lower. Like, that's a
great
huge
rate.
rate drop. Like, yeah. So, people have this idea of the Bank of Canada, Bank of Canada, Bank of Canada. And I know I say this every single week, so I'm sorry for everyone who listens week to week, but the Bank of Canada only impacts. So if you're a variable rate mortgage holder, then yeah, you should definitely be waiting. But if you're a fixed rate mortgage holder, you're going to miss the boat. Like, the boat's going to leave the port and you're going to be waiting for this big rate drop. And then there's going to be a bunch of other buyers that are waiting for the same thing, and it's going to be too late. So I think we are going to see a shift. I do think that home ownership is one of those things where, the younger generation, I don't think it's like, Adam, you're mentioning it. It's one of those things where real estate is front of people's minds from like investment and ownership standpoint. Like, as Canadians, it's just something that's kind of inherent in our minds. But I think the next generation, like, my daughter and my son and so on, their age group, I don't think real estate is even on the spectrum of ideas right now, and probably not for the foreseeable future until something, like these 30-year new build type mortgages where it becomes actually feasible, where it's like, oh, maybe this is something I want to do, but not for the sake of investment, for the sake of actually having like a long-term asset that will grow over 25 years, not as we've seen over the last 5 to 10. Oh, I'm going to buy this investment property. And, all these people that bought these new build condos in Toronto that now can't close on them because, prices are down and rates are up, and they bought them as a short-term flip. And now they're caught with their pants down, for lack of a better term. And so yeah, it'll be interesting to see, like, over the next 5 to 10 years, how the mindset of home ownership in Canada shifts, because
it's totally
of these sorts of rule
changing.
changes.
It's totally changing. I think a lot of people are giving up on it, and kind of in respect to how it's being presented to them as well. I think they've just completely given up on that, which, it moves them. I think people are learning more that there's other things that they can do instead of get into home ownership, from people who have been trained to believe that home ownership is the only asset. Like, it's like the most important one it is important, obviously, but I think there's a big shift in that between what people are learning online now and, with help of other platforms. But, the idea of, how we've said, or I've said on the show before, it's not necessarily a bad thing to rent, just, rent and put your investments elsewhere. I think that mentality is kind of coming about, especially in Canada, because people are realizing like how difficult it's become, and like, why am I going to stress and break my brain over trying to get into a home when there's other things that I could do slowly to build up potentially more income and then be able to buy a home later. But a lot of people just get caught in like, I need to earn more money at my job to own a house. So I think that that's kind of shifting a bit, just because of the way Canada's been kind of destroying that dream for people over the last couple of years, for a lot of people anyways.
What a great way to end off. What a high note. What a high note.
Great.
Way to just lift everyone's spirits.
Going
Greg.
back to my point before, though, I will say for one of the first times in years, I'm the least buyer heavy that I've been. And it's been interesting to see, the conversations that I'm having, and a lot of seller clients that I have, they're just sitting and waiting. But all of a sudden now, as I'm saying, there's more listings coming out than buyers. We've got a bunch of listings coming out. So I'm hoping that the buyers are actually out there to purchase these properties. At the same time, open houses are a lot busier, way busier than they've been in recent years, I want to say, just in general. And, the buyers are potentially there, but a lot of them are just coming through and just kind of thinking about it, seeing what's going on in the neighborhood and everything. So it's going to be interesting to see what happens with my personal business over the next 3 months, because there's a lot of properties coming available. And I want to see how much of those flip into buyer clients, just based on open houses and the leads we can generate from a listing.
Yeah, I think just wrapping up this overall conversation, I think the psychological side of things is something that is the unknown. Like, I think someone mentioned last week too, when we had another guest on, And I remember them speaking about the mentality of, like, it used to be you buy a home, it's a really good long-term asset. You know, it's, as you said, Adam, it's, you know, it's tax-free when you sell it down the road. But people used to buy a home, like my parents still live in the same home they bought 40 years ago. You know, like you buy a home, you'd stay in it forever. That was kind of that's what people did. That's just what you did. Then somewhere along the line, maybe 5-10 years ago, it feels like that people started thinking of their home as a ATM, right? Like you kind of move into it, you get some equity, you reinvest that money, you sell it, you use that money, you reinvest, you just kind of constantly going back and forth. And I think that mentality will shift. Like I think that, you know, with the tax implication, things that are coming into play, I think people will kind of start shifting back into that. Okay, I'm going to own that one asset and own it long term, and then I will invest elsewhere as well. Obviously, there's still going to be real estate investors. I'm not saying that's going to go away, but I think that the mindset of home ownership will shift, or at least it's going to shift in some capacity. But I'm thinking it'll probably go back to that. Okay, let's own our home long term and not play Monopoly as much as people have been trying to play Monopoly over the last 10 years, it seems. It's my own 2 cents. Closing remarks, Adam and David.
Good. I think you guys summed it up pretty well. Nice downer send off.
Doom and gloom.
Doom and gloom.
On a Monday.
At least is this the episode where the haters don't say that we're pumping the market and that TOREP controls the market? Is this the one episode where they're like, I agree with you guys?
Well, I think Paul really needs to boost our mood. That's for sure.
We're with you, haters. Yeah. I'm getting notice that my connection is unstable. So if I cut out, I apologize. But I have 4 today. So here we go. Number 1. If you want a job in the lotion industry, the best advice I can give is to apply daily. Tough to get it in there. Number 2. What is the name of Bruce Lee's vegetarian brother? That's, of course, broccoli. Broccoli. Wow.
I was actually just going to say that. Damn, I would have got one.
Yeah, you would have got one out of 1,000.
Yeah.
Number 3, why did the cookie cry? Why did the cookie cry? Because her father was away for her so long.
Oh, I thought you were going to say because he felt crummy.
Yes.
Oh, wow. He was very brittle.
Two
Number 4,
2 punchlines.
last but not least, what do houses wear? Address. Address. Had to get the real estate topical joke to end.
That one was a win.
Thank you.
That was a win.
Thank you, Adam. Thank you for being here with us, taking the time out of your busy day. And we were admiring his backdrop. Much nicer
I love
than
it.
ours with the plants.
It looks like my house.
Photos and shelves.
It's
I have
fake.
those same plants on the shelves.
It's a fake backdrop.
Is it? Good job.
No.
Nice.
Thank you, everyone, for listening. We will be back next week. We record every Monday. We release every Tuesday at 10 a.m. on all platforms. And thank you to our sponsor as well, Campbell-Maric Law, amazing law firm. We appreciate their support. And we will be back next week. Have a great week, everyone. Take care.
Deuces.
Thanks for tuning in, everyone. We hope you enjoyed today's episode. Please remember to like, share, comment, and subscribe because we'd really like that.